Hey, welcome back to The Dive. China on base metals demand, the copper price, copper and the green energy evolution, gold, the company's elevator pitch, resource estimate, and things investors should know are the topics that our guest will deep dive into today. He is the president, CEO, and director of Solaris Resources, Inc. Daniel Earle is joining us today. But before we bring you Daniel's interview, do me one quick favor and just go ahead and smash that subscribe button, please. Hey, Daniel, welcome to The Dive.
Hi there.
Okay, so let's dive right into it here. China accounts for a substantial amount of global metals demand. Do you think that their zero COVID policy has a direct effect on the base metals market?
Yeah, absolutely it does. I mean, China, as you say, it's absolutely massive in base metals. I mean, by far the largest player in terms of global demand. I mean, it's anywhere, when you're looking across the metals, it varies by the specific metal, but it's anywhere from 40 to 60% of kind of total global demand there. And for copper, which is what we're primarily concerned about at Solaris, it's about half of global demand. And that's those figures are growing and growing pretty rapidly. You can see this if you think about the sort of the strategic direction that the country is taking. They're talking about, basically decarbonizing, getting to peak emissions by 2030, full carbon neutrality by 2060, and doing this through a strategy of essentially electrifying everything from transport through residential, industrial, renewables, smart grid storage, all this sort of stuff, basically replacing fossil fuels as the sort of main energy source for the economy. Going from something like a quarter penetration now all the way out to, 35% by the end of the decade and above 50% by the middle of this century. So that, so China is really rapidly growing its copper demand, but other countries are growing more quickly. So you have India coming along where you've got that really rapid economic growth paired with urbanization and the increase in standards of living. It's a lot like what we saw with China, which triggered the last commodity super cycle in the mid 2000s. And of course, the decarbonization and the energy transition, it's not only about China, it's a truly global thematic. So this is a third between China and the other major economic centers, Europe and then the US. So yeah, look, China is absolutely central to base metals all the way across the complex. When you have policies like zero COVID, which translate in the context of these more transmissible variants that we have now, pretty directly into shutdowns. So more shutdowns of increased duration, and of course these have an impact on the market. And so this would be similar if you think about the effect to what you would get from like a Lunar New Year shutdown, which we just came through. In a normal year, that would lead to a build in metal inventories on exchanges. And then obviously that translates directly into softer prices. That generally is a Q1 phenomenon, and then it sort of resolves itself over the course of the year. And in copper, to speak specifically about copper, we've seen that same sort of build, across from very low levels recently. Now into Q2, and then of course we've been hit with a raft of guidance revisions. We saw the first series of these come through with annual guidance numbers, and then now after Q1, companies are reassessing and guiding to lower copper volumes across the year. And I think when you put all that together, with a low starting point in terms of inventories, even if we saw a bit of a build, and then going back into a period of draws now with this supply underperformance, which is a very normal phenomenon in the copper market, then I think we're going to continue to have a pretty tight market.
Okay, so some commodity analysts are even calling copper the new oil. How do you really see copper evolving with the world economy and the green energy revolution? And where do you see the price of copper heading from here?
Yeah, well, look, it's a great question. I think that phrase, copper is the new oil, that was coined by Jeff Currie at Goldman Sachs. But I think it was a broader point about the central role of copper in electrification, and electrification being more than just about replacing fossil fuels in transportation. Obviously, electric cars are using something like 3 to 4 times as much copper as ICE powered cars, internal combustion engine cars. But really, I think, copper as the new oil is more about copper just being or becoming the most strategically important kind of commodity and replacing oil in that broader sense. And so this is about the full energy transition. So not just transportation, but, decarbonization as a whole and the path to net zero, which takes in, beyond transportation, residential, industrial, reconfiguring infrastructure, building new infrastructure, power generation with renewables instead of fossil fuels, the grid build out to handle all of this electricity. And of course, copper is the indispensable metal. It's wiring all of this together, or making this all possible. And the reason it's so strategically important is because it's irreplaceable. So not only is it fundamental, but it's irreplaceable. It's not subject to the same kind of technological, demand destruction that you would have, say, for the so-called battery metals, which all to one degree or another are seeing, as a result of their price outperformance, demand destruction come in through substitution and so on, which is obviously a key focus of technological development. In terms of the copper price, it's really a tale of two parts. Okay, the first part is basically the market that we have at present, which is a very firm market. We talked about it. It's well supported at these levels, in spite of all the macro, kind of carnage that we're seeing around the Russia-Ukraine war, supply chain issues, China concerns, US concerns on economic growth around rising rates, all this sort of stuff. Because you've got the market needing to balance itself through the price mechanism on a day-to-day basis. Okay, and so when you think about those low inventories that we had due to the supply, at the start of the year, due to the supply scarring from last year, and then a bit of an inventory build, so maybe a brief respite where we saw the copper price soften up a bit, but then straight back into more supply concerns and now draws forecast across the end of this year. So that's going to be, that's a recipe for a firm market in the short term. And so I would say that we've got a copper outlook over the next couple of years where I think these conditions will hold in the $4 to $6 range. Where it gets really interesting is when you look out to the middle of this decade, so 2024 going into 2025. And this is when you're starting to see, the structural deficits open up as a result of, the roll off in legacy supply, and then the pickup in this green demand. Okay, and these structural deficits keep growing out to the end of the decade and even beyond. Copper's long cycle now, and so to bring on copper projects by the end of this decade, you need to already see them in the pipeline, and they're just not there. So we're talking about a supply response, which is going to be a very long way out in terms of meaningful new, greenfield supply coming into the market. So I think when you take stock of that sort of a dynamic, when you're looking at the middle and the back half of the decade, you have to be much more optimistic about copper. And I personally think copper price will be well supported in a range from $6 to $8 across that time frame, with potential for price spikes, up into double digits, which would reflect sort of a security of supply type panic, like you saw, for example, in, say lithium last year, or even into this year, or nickel earlier this year, where you saw the price up 250% in just a short period of time. So that, I think, is basically the story of the copper outlook in two parts.
Okay, so now to your point, we're obviously going through this transition period in the world with the grid 2.0 and electric vehicles. How have the conversations changed over the last 6 months when you talk to investors about a junior mining project versus, say, 4 years ago?
I think when you're talking about the fundamentals of commodities, and especially, look, I'm talking about copper primarily. The conversation really hasn't changed all that dramatically over the last couple of years. But if you go back prior to that, I think it was a different, the pre-COVID period is different than the post-COVID period. You've seen just, everything become upended. You've seen trends that, even if you foresaw them, have accelerated massively in the wake of COVID, in the wake of massive, fiscal spending and government kind of government-led technological and economic change. So they're two different. It's hard to compare across that full period, but really over the history of this company, which is entirely in the post-COVID period, the conversation on the fundamentals hasn't changed so much. I think there's a broad consensus that these, mega trends, the energy transition, decarbonization path to net zero are trends that are going to hold and accelerate going forward. So I don't think there's a lot of disagreement about that anymore. And certainly around copper and the fundamentals of copper vis-a-vis those trends, I don't think that there's a lot of disagreement. I think where the disconnect is that people just, even if they accept those ideas on an intellectual level, haven't actually put them in practice in terms of, investments. And so we're not seeing the market outcomes yet. I think that companies like Solaris, copper companies in general, are massively, underappreciated in the market at the present time. Now, if you're asking about Solaris, the Solaris story itself, the story hasn't changed at all. Okay, so we've been saying from the beginning of this story that we had a world-class asset at Warintza, and that we were going to do is set out to establish its world-class potentials through a resource estimate. We told people specifically that we were going to drill a 1 billion ton resource inventory in an open pit with a high-grade starter pit. And then all we've done is we've gone out and delivered and really outperformed on those expectations. So our story has stayed entirely consistent across the life cycle of this company. As short as it is, we're only coming on our 2nd year anniversary in July.
Okay, so the company announced its resource estimate at the Warinzta Copper Project in southeastern Ecuador and outlined a potential starter pit. Could you walk us through these results and what does this mean for the company?
Yeah, the resource update, that was a major milestone in this company. That's essentially what we've been working towards for the last 18 months. Over the life cycle, the short history of this company has all been entirely geared towards delivering that resource update. And that resource included a total, this is across the all resource categories, of 1.5 billion tons of resources grading over 0.5% copper, which is high grade in the context of the current copper industry. But then within that, a very robust starter pit, again, across all categories, 280 million tons grading about 0.8% copper equivalent. And so, when you look at that picture, the scale, of course, is impressive. 1.5 billion tons is rare on its own. But the key is really the starter pit. That's a really critical differentiator between truly world-class projects like this one, that get acquired and get developed rapidly, versus more marginal projects that sit on the shelf. Even if they're large and they have a decent overall grade, if they don't have that high-grade starter pit, then it's a difficult project to get up and off the ground because of how central that starter pit plays a role in the economic returns of the project. And we haven't completed, to be clear, any economic analysis at this stage. But if you look at what the analysts are publishing about the importance of that starter pit, so when they're looking at 280 million tons at 0.8% copper equivalent and running that through their models, they're generating something like a $50 a ton margin, which if you're doing 20 million tons per annum, like the mine that's about 40 kilometers down the highway from us is, that translates to about $1 billion a year of EBITDA. And with the inventory that we have in that starter pit, that would run for 15 years. And with a project like this, we're not talking about massive capex. And this is another really key differentiator between large projects that kind of move slowly, and then large projects that are really robust and then move quickly. It's all about that infrastructure. And this, when you look at our district, the mining district that we're located in southeastern Ecuador, the structural advantages that we have pretty clearly are going to translate into billions of dollars of capital and operating cost efficiencies. These are things like the nearby power grid, which has access, cheap, clean, low emission, zero emission, obviously hydroelectric power, the low elevation that the project is located at, the low cost labor that you have in Ecuador, and the freely available fresh water. This is often overlooked by investors, but fresh water alone is something like $1.5 billion of capital savings or competitive advantage when you're comparing it against Chilean projects. Chilean projects invariably now have to build desalination plants at the coast and pipe water in. That's the major competitor for our project. Chile is the #1 copper producer, of course. And so this infrastructure, this is the difference. All the things that I talked about between, what would be a $6 billion project if it was in the Andes of Chile or even Peru or Argentina, and something like a $1 or a $2 billion project that you have in our mining district of Ecuador, or say the equivalent in BC or Arizona or Mexico, where you've got that kind of infrastructure. So the bottom line with this resource is we think that it already very clearly establishes Warinzta as one of the most robust greenfield copper development projects in the industry. But we're going to grow this. This is a baseline, this resource based largely on one of our 4 deposits that we're going to grow really rapidly from with the drill program we have ongoing.
Okay, so for investors who are watching the story, over the next 3 to 6 months, what are the things that they should be looking out for in terms of timelines?
Well, it's all about that growth agenda that I just talked about. I mean, we just delivered 1.5 billion tons. We did it in less than 18 months of drilling. But really, from when we got our drill program fully ramped up, it was about 6 months of drilling. And that was on only one of the 4 deposits, or largely one of the 4 deposits that we've discovered to date, with the last 3 of those 4 discoveries just coming in the last year or so. Okay, and even that first deposit is still open, let alone the other deposits, which are either wide open or not part of the resource at all. And so it's all about growth. Okay, and I think one of the things that people missed when we released that resource, or the press release for that resource, was that it only took in drilling up to the end of November last year. And we didn't stop drilling then. We've been drilling for now, coming on 5 months since that time. And we haven't put out the results yet because we haven't had the assays. We've been focused on the resource. But as those results come in, then we'll be putting out the results of that now nearly 5 months of drilling, which is all directed at this growth agenda. So that's growing both the high-grade starter pit, okay, with the extensions in high-grade near-surface mineralization from Central, where we drilled one of the best holes that we ever drilled, was also one of the last holes that we drilled at Warinzta Central. It was right on the edge of the resource. So the step-out drilling on that aimed at delivering growth into the starter pit. And then, of course, the overall growth drilling off the east deposit, which will form part of the same pit, and even beyond that. So it's all about growth of the overall inventory, but then crucially, growth of that high-grade starter pit, which is really going to drive the growth in the value of the project as well.
Okay, so Daniel, one more thing before we let you go here. We wanted to get your take on gold. What do you think needs to happen for gold to leg up higher from here and sustain itself?
Well, gold is already at an elevated level. So this is not. If it weren't for the cost structures of a lot of these marginal producers, the gold industry itself would be generating phenomenal amounts of free cash flow at these gold prices. So we've got good gold prices. I guess when you think about gold, the best long-term correlation for gold is just to the inverse of 10-year real yields. Okay, so which is the difference between nominal yields and then inflation rates. And so if you look at the 10-year real yields, they would have bottomed around 1%, so minus 1%, coincident with the peak or near peak in the gold price around August of 2020. And then they sort of, gold obviously sold off from that point because people anticipated that, there would be a liftoff in rates and so on. And, you basically look back on it now and in fact, negative, real yields continued to sort of trade sideways from that level in and around that minus 1% level. And then they've ticked up more recently, obviously with the liftoff in interest rates in the US. And expectations, you've seen a lift in the nominal yields that corresponds to that. But typically, when you look back on most cycles, most interest rate hiking cycles, typically like long yields will peak around the time that you get liftoff. So a lot of investors, make the mistake of thinking that if short-term rates, if the Fed is hiking rates, then long yields need to be going up. But in fact, the market anticipates this, and yields, tend to actually peak around the time that you get liftoff. So I think it's going to be a combination of the two things that are driving, long real yields. So it's going to be inflation, and then it's going to be an easing, or at least a peak in those long yields, which I think we're, if not there, we're very close to that level at in and around 3% on the 10-year currently.
Okay, well, that's all we have for you today, Daniel. Thank you so much for coming on with us and sharing your thoughts with us. It's been a pleasure.
Thanks so much for having me.
Thanks so much for watching today. We'll be back again tomorrow with the latest news and updates. So be sure to follow along by hitting that notification bell and subscribing below. Goodbye.